Welcome to AM Best Audio.
Welcome to our panel discussion on insurance asset management in the new investment environment. I'm John Weber with AM Best. As we navigate through an ever-evolving financial landscape, insurance companies are encountering a plethora of challenges and opportunities in managing their assets effectively. With shifting market dynamics, regulatory changes, and emerging technologies, it's crucial for insurers to adapt their investment strategies to optimize returns while mitigating risks. A distinguished panel of experts that we've assembled here today will share insights, strategies, and best practices for navigating this dynamic landscape. Together, we'll explore innovative approaches to asset allocation, risk management, and harnessing new investment opportunities to thrive in this new era of insurance asset management. And now let's meet our panel. We have with us today Deanna Layton, Vice President and Portfolio Manager at AllianceBernstein. David Chernecki, Chief Investment Officer, Nassau Financial Group. And Susan Chung, Chief Investment Officer for Amica Mutual Insurance. And Susan, let's kick things off with you today. Are insurers rethinking allocations?
I think so. I'd say yes. And part of it is, a large part of it is where rates are today relative to where they've been since the global financial crisis. We had COVID, and the backlash of COVID was high inflation, and then rates followed. And so for the first time in decades, rates have been attractive relatively from where they were for the last decade. So yes, really thinking about in our portfolio, we had previously had equity. We had held more equity than we had, I guess we would prefer, because of the low rate environment. And we're rethinking about putting more into fixed income now because yields are at an attractiveness level they haven't been for about 15 years.
David, Susan mentioned the interest rates. How has the rise in interest rates changed how insurers are managing portfolios?
Yeah, Susan touched on this really well. After a long period of essentially zero rates, insurers have, really, it's probably one of the biggest shifts I've seen in a long time in terms of the plethora of things that we can now look at. We keep some charts internally on what asset classes are attractive relative to the yields we have to pay on our policies and our crediting rates. And for the longest time, very few asset classes fit that hurdle. And what we saw in the last few years with rates having moved up quite substantially, although they're still not necessarily high by historical standards, but certainly much more to choose from, much more flexibility. I think we're managing a little bit more dynamically as a result.
Susan, I notice you nodding your head there in agreement.
Absolutely. It's a bit of a double-edged sword, though, because while rates are high, spreads are tight. Spreads, in fact, are probably almost at historic tights currently. And so you're really fighting this game of where the all-in yield is quite attractive, but on a relative basis, particularly if you have portfolio managers or have a mindset of a total return, it's tough to load up on some of this spread product in fixed income. So the theme seems more recently to be up in quality. So we're up in yield, but also up in quality. And, I add, and interesting, Dave and Deanna, what you think, we've had a long period of time without a true credit cycle. And interesting how you think about that as, with such attractive rates. And if you want to reach for yield, what you're willing to do.
Yeah, Susan, I can jump in there just because I totally agree with you. We're in a very interesting environment where yields are very attractive. However, spreads aren't so much. And we totally are in alignment with you in terms of making sure that you're up in quality, as you're not really getting paid to go down in quality at the moment, remaining very diversified across products. So not just in, investment grade corporate bonds, but looking across securitized products and also private alternatives to really diversify the book away from kind of large developed market, public corporates as well. And really looking at stable credits and where we can clean up our portfolios.
Yes, and we've conducted similar exercises within our portfolio as rates began to come up. There was a big push into more liquid product, and public markets repriced more quickly as that was happening, so it was easy to do. Now that spreads have really compressed, being a lot more selective. I think in the parlance of we play in bonds, but the parlance is stock pickers market, right? You've got to really pick your spots here today. All right.
Here's a question. I'll toss this in. Is the curve is just such an odd shape currently, where the short end, frankly, all in is and Deanna mentioned securitized product. I think that's one of the attractions of securitized is there's that hump in the curve at the front end, and then the back end is just, I mean, it's up where it's been from where it's been, but still relative to the short end, front end of the curve, it's can't really compete, it seems.
Yeah, absolutely. I think that kind of leads into another point that liquidity is an interesting issue for insurance companies, particularly as allocations shift from private markets or from to private markets from public markets, and also the usage of FHLB programs in some cases to enhance liquidity, but the collateral the assets that are encumbered are actually the highly liquid assets and other types of hedging programs. So the interesting part about the higher yield environment and actually the curve inversion is the opportunity cost of boosting liquidity is actually the lowest it's been in decades. So short ABS can really act as yield enhancing complement to more traditional money market products like commercial paper and time deposits as well.
Keeping with that theme, Deanna, what are you noticing in the way of liquidity for insurers?
Yeah. So I could talk about this for a long time. I think what insurance companies really need to do is post pandemic, interest rates have gone up, but so has rate volatility. And a lot of insurance companies utilize hedging programs in order to manage that rate risk. And as rate volatility increases, the liquidity needs on those hedges also increase as well. So looking at the liquidity, because with those hedges with FHLB, a lot of the assets are encumbered that are highly liquid. So what we're doing is parsing through our portfolios, looking at what's actually tradable, what can we actually execute, and making sure we're comfortable with the level of liquidity across portfolios.
All right, thanks, Deanna. We're going to take a short break, and when we come back, we'll explore the ever shifting winds of asset allocation.
Insurance companies can structure in the private markets a little better to better fit asset liability targets.
We're back, and we're speaking with Susan Chung from Amica, Deanna Layton from Alliance Bernstein, and David Chernecki from Nassau Financial Group. And David, are you seeing a shift in asset allocation these days?
Yes, we absolutely are. As we spoke before the break about the changes in liquidity, the changes in the inverted yield curve, the changes in spreads, all of that has had a fairly big impact. And what we're doing here and what we're seeing amongst a lot of our peers is a general move up in quality, an increase in liquidity, and a general broader diversification of assets and asset allocation in sectors than we had seen, prior to the move up in rates. Again, as I mentioned earlier, prior to that move up, the selection of things that could, satisfy insurance liabilities was extremely limited, and it forced insurers, all investors, really out the risk curve a bit. And we've seen a very quick sprint back to try to recover some of that and get back to what I would call a more normal asset allocation, sort of a return to normalcy, as they say.
Deanna, are you surprised there hasn't been more of a shift back towards publics considering how interest rates have been moving?
Absolutely. In this higher yield environment, it definitely seems like public bonds are back in terms of what they can provide for insurance companies, as my colleagues have just spoken about. However, data shows insurers generally are continue to increase allocations to privates, and I really think it's for multiple reasons. The first is insurers view private asset classes as more strategic versus tactical. So they're increasing those strategic asset allocations over time to get more towards what they view as optimal. It also enhances portfolio diversification. As I mentioned before, many insurance companies are heavily concentrated in large developed market corporates. Privates taps medium and smaller corporates, consumer risk, and commercial and residential real estate risks. So definitely a way to diversify the portfolio. Also, for those insurance companies that can, they could take advantage of illiquidity premiums where it makes sense. And then also, from a structuring perspective, insurance companies can structure in the private markets a little better to better fit asset liability targets. So finally, there's an attractive opportunity from a tactical standpoint as well, because what higher yields have done is created situations where banks are actually pulling back and insurers can step in tandem with private alternative managers to really gain access to attractive pools of risk.
Those are great points, Deanna. The other thing I noticed is that, and certainly we took advantage of this, when rates started to come up, I think the public market repriced far more quickly than a lot of the private markets, both from a yield and spread perspective. And so as we had money to deploy, we took advantage of that and we bought a lot more liquid paper. But part of that was also driven by the high degree of uncertainty. While I wouldn't say we're out of the woods yet economically, and there's still, with the inverted yield curve and other factors and sticky inflation, still things to be worried about. I think if you go back to when all this started, we were truly worried about some type of debacle or something really bad. And so having liquidity, in public assets was just very, very attractive. As things have maybe not gotten 100% better, but improved, and the outlook is not quite as frightening, although it still, can be nerve-wracking. I think we're all a little bit more comfortable deploying money on a little bit longer term basis and a little bit less, liquid space than we were, say, 2 years ago.
I'd agree with that. It's so interesting. I feel like in the whether it was COVID or before that, all sorts of different things, it seems like the possibility of black swan events seems to be greater for some reason. I think liquidity is maybe a bit underrated. I think liquidity can take a lot of forms. I think right now, P&C insurers right now, with the combined ratios and the operating losses because of the lag of rates, rate adequacy following, the lag regulator approvals. Needing to have operations funded from the investment portfolio. I think liquidity is really coming to the fore, especially when a large part of the bond portfolios are underwater just because of where rates have moved. I think that has been a strain for many insurers. But even going forward, I do think that there are parts of the, I would call it alts or private credit part of the spectrum. I'm specifically talking about private credit to small and kind of small entities, what the old bank lending used to be. I do wonder. I think putting money in today is probably very good. Rates are high, and credit is difficult to come by. So underwriting is very strict. But I do wonder some of the pre-COVID lending. I wonder how robust some of those credits are. I don't think it's been through a proper cycle. And I think probably a lot of the people who put money there have never been properly through a cycle.
Susan, the theme here this morning seems to be the higher rate environment. Does that entice insurers to take more or less risk?
I would say it entices insurers to take less risk. Number of reasons is one, rates are just higher. So you don't have to take that much credit spread to benefit from the higher rates. I think higher rates also hurt risk assets. Look at equities. Your discount rate is higher, and so your present value is lower. I think there's entire swaths of the alts area that will be affected if we maintain this higher rate environment. In particular, I'm talking about venture, which was so hot for such a long time. For those insurers who have a small alts portfolio and have money in venture, I think when the era of free money maybe probably not gone forever, but will be gone for a little while. And these operating loss, money losing firms will not be able to live as long as to get to the IPO.
All right, we're going to take a short break, but when we come back, we'll search for the opportunity in this investment cycle.
A couple of things where we've had, sort of mined a little bit of diamonds in the rough, we think, are certain subsectors within that medical and professional space, for instance.
We're back, and we're speaking with David Chernecki from Nassau Financial Group, Susan Chung from Amica, and Deanna Layton from Alliance Bernstein. And Deanna, where do you find the value and opportunity in this high yield environment?
Yeah, so as we mentioned before, it's an attractive yield environment, but a tighter spread environment. So for that reason, our focus is really building high quality portfolios and remaining diversified and enhancing diversification. Within credit markets, within USIG, we do like larger banks versus regionals. We still think that that's dislocated a little bit. However, don't want to step down into the regional banks as much in the vein of being higher quality and continuing to invest in stable and improving credits. Emerging markets haven't looked as favorable in 2023, but now look more neutral versus USIG. And US high yield continues to stream pretty unattractive versus its investment grade counterparts. So not really getting paid to go down in risk there. Within securitized products, we do like the auto space in ABS, as well as the more esoteric ABS space. High quality CMBS spreads have definitely come in, but they do look relatively attractive and they're a little bit better of a structure from a longer duration bullet structure for an insurance company. Agency CMBS spreads have lagged, so for insurers that are willing to take on some prepayment risk, I think you're finally getting paid there to do so. Within privates, I think new ideas, NAV loans, net asset value loans look attractive, but manager selection is key. It's a newer asset class. Specialty finance presents a unique opportunity really to capitalize on that pullback from regional bank lending. And then residential home loans are an interesting opportunity because they are FHLB collateral eligible, so you don't have to take out your liquidity assets and encumber them from a collateral perspective with the FHLB. And then private placements, commercial mortgage loans, middle market loans continue to be good sources of diversification for insurance companies.
What do you think, Susan? Do you like those opportunities?
I think there's a lot of interesting opportunities. I tend to think of the where we have really looked into is the shorter end, securitized, esoteric ABS. I do think some areas, for me at least, I'm a little cautious on CMLs. I think there's just the commercial real estate space generally is fraught with uncertainty, particularly on the office area. Retail clearly has been affected. And what I worry about is not that we don't know what it is, but it really probably hasn't been marked properly yet. And there's a lot of extending and hoping things will be better into the future. So not quite clear. I also worry about a number of insurers have fairly large real estate allocations, not only insurers, other investors as well, and have those allocations changed, even though certain asset classes have largely been taken out of the investable space and crowding into industrial space or transport or multifamily.
Yeah, that's interesting, Susan. We we do some commercial whole loan lending as part of our portfolio, and what we've had a theme for quite some time now to steer away from certain things. Now, we're not in the big markets. We don't we don't have loans to big office buildings in Manhattan or anything like that, and we have generally been very underweight office and things of that nature. But a couple of things where we've had, sort of mined a little bit of diamonds in the rough, we think, are certain subsectors within that medical and professional space, for instance, medical in particular, where the in-office occupancy rate is quite high, right? Because, you still physically go to the doctor, you physically go have your knee, replaced or whatever it is. And so we saw that as a subsector. Obviously, the shifting retail economy has put pressure on traditional retail. At the same time, that is part of what has driven the distribution, the need for distribution space and things of that nature, data centers. And it seems like that, I don't want to call a market bottom here by any stretch of the imagination, but it certainly seems like from everything we read about AI that this is just the tip of the iceberg in the amount of data centers and stuff we'll need. So it's funny, there are little pockets within the whole loan space where I think there still remains some opportunity.
Totally agree. The fundamentals are really strong there. What I worry about is everyone's allocation remains the same as they're crowding in.
David, I believe it was Susan that brought up the inverted yield curve earlier. How are insurers reacting to an inverted yield curve?
Yeah, we did touch on this a little bit. So this is a really fascinating part of this whole dynamic because it really is two sides of the same coin. If you I think part of it depends on what your liability structure is. If you're, a P&C company with a total return portfolio in a, relatively short duration liability portfolio, you're loving this, right? Because you're making more money on the front end of the curve where you're kind of forced to be anyway, right? If you're a life company and you're writing long dated liabilities, here you are looking at an environment where rates are higher, more or less higher than they've been in a very, very long time. The direction of rates is uncertain, but probably more likely down than up, maybe for good reasons, i.e. we've gotten inflation under control, maybe for bad reasons because we forced a recession. But again, maybe the bias is a little bit too neutral to the downside. So you'd like to lock in this opportunity. And, if you're a mutual company, then that's probably fine. If you're a public company, people are saying, well, where's my earnings this quarter? So now you're sort of tilting back toward the front end of the curve. So I think it's put a lot of pressure on the investment departments to sort of thread a needle of generating enough near-term income while also trying not to miss an opportunity here to, maybe not extend duration, but sort of neutralize it and kind of keep it up there, keep it out there in this environment. And then the other thing we talked about earlier is liquidity. Obviously, the shorter end of the curve gives you more flexibility. And then lastly, I'd note that, the ability to turn the portfolio over, particularly if you're a public company, is a bit more challenging because your old portfolio is very much underwater. So this repositioning, part of what you're doing is trying to take advantage of the front end of the yield curve, but part of what you're doing is using what limited dollars you have to rebalance your portfolio and get your ALM positioning right for the current environment. And you can't necessarily, there's a big slug of your portfolio you can't necessarily move around. Even if you're not public, it's going to hit your stat. And so you've got to consider your IMR and things of that nature. It's a very, very challenging environment. Listening to Deanna and Susan and thinking about what we're doing, I do think, and I've talked to others too, I do think the bias is to be a little bit shorter and take advantage of that curve.
It's hard to resist. It's hard to resist. The front end in terms of credit quality, risk, and just all in yield is very attractive. And I agree. If you're a total return PNC, it's a pretty attractive time. A lot of opportunity, particularly in assets that you don't. I think there is this fatigue of just constantly reaching for yield and going further out in credit. And I think this is a little bit of a respite on that. Although, as you said, David, a bit tricky on where to play and limited resources or new money because for a portion of the portfolio, by definition, is underwater.
If that's the case, Susan, is this credit cycle different than traditional credit cycles?
Well, is it a cycle if it's decades long? I don't know. It seems like it has to happen. It's funny. It's almost like musical chairs. People are waiting for it to happen. It would almost be a relief when it happens that we get to start over again. Because I think some may point to COVID in 2020, but it really wasn't much of anything. Maybe a few weeks at best. And then we had a little blip in March of last year, but really things continue to truck forward.
Okay, Susan, you're right in the thick of it there at a mutual insurance company. What are insurers doing differently in their quest for yield?
Well, we're really looking at the higher yield opportunities, and as we've said, um, veering a little toward more to the front end of the curve, and but staying up in quality because if we don't know when the chips will fall and we'll hit a credit event. But also, we've thought about reducing our equity, and we have done it in some portfolios. We're holding public equities as an insurer, and it's been done very well for us since the financial crisis. But we are reducing credit or public equity in favor of credit, fixed income in other portfolios to take advantage of this higher yield environment.
Thoughts, Deanna?
Yeah, I think another thing to focus on too is remembering the annuity providers and the prevalence of private equity in the space, shifting portfolios to be for better or worse, more aggressive, more innovative. And I think that there is still somewhat of a reach for yield because from a annuity pricing perspective, the portfolio spread matters in order to be competitive too. So I think that as much as, there's an up in quality tilt, I think from talking to a lot of clients, there's a pressure to be competitive from a liability side as well.
Yeah, and we certainly see that, John. I mean, that's what we do for a living, and we certainly see that. I will say that over the last several years, and we're feeling a little bit more now, but over the last several years, I think as an industry, the annuity industry has been relatively disciplined, and that's in part because of the fact that there was a pretty strong tailwind of growth across the industry. So a rising tide kind of thing where everyone was growing at a nice clip. We've seen the industry come up quite a bit. And so I think that it eased the pressure that Deanna was talking about a little bit. But I don't want to say the growth has slowed. I think it's too soon to tell. But I think with this drop in spreads that we've seen very recently, significant drop in spreads, I think you're seeing a little bit more competitive pressure there.
And on that note, we're going to wrap things up today. David, Susan, Deanna, thank you so much for an outstanding discussion here today. We would also like to thank NEAM for sponsoring this discussion. For AM Best TV, I'm John Weber.
Looking to get the full attention of the insurance industry? We have the platforms that will do just that. Whether it be AM Best TV, AM Best Audio, Best Review Magazine, or Best Day. Find out more by calling AM Best Advertising Sales at 908-439-2200, extension 5399, and have a great day.